takes us to our talk of the tape. With 6 weeks left in 2024 and the S&P on pace for a second straight 20% annual gain, how does the risk-reward equation break down for the rest of the calendar year? Let's ask the panel. New York Life Investments' Lauren Goodwin, VantageRock's Avery Sheffield, and Invesco's Brian Levitt. They are all, thankfully, with me here at Post 9. Good to see everybody.
Good to see you.
So, Lauren, it's a big question of kind of what's changed, how maybe it has changed, how much has the market figured out over the 2 weeks or so since the election, and where that brings us right now, because it seems interesting. We're having a little bit of a stop and think moment in the last several days.
I'm having a stop and think moment right now, thinking about, you just said there's 6 weeks left in the
That's
year.
It,
it's really hard to believe.
6 weeks in one day. Yeah.
But you're exactly right. The market is trying to decide which of the Trump trades to fade and which to follow. And from our perspective, there's a pretty clear line on this. You follow the trades that are not just supported by potential policy change. We're all going to be going back and forth around what's likely over the next couple of months, maybe a couple of quarters. But follow the trades that are related to the underlying economic trends that might be accentuated by that. So these dynamics we're seeing in interest rates, in currency, a little softer off the top today, but these are the trades that I expect are likely to persist.
So you think that there therefore is more upside to things like Treasury yields and the dollar at this point? And what does that mean perhaps for equities?
I think we should expect to see inflation and interest rates in particular more volatile, as well as higher over the next several quarters. And that's because we see not only a growth impulse from stronger economic data, but the likelihood that we see policy support from the new administration in those areas. Now, in both cases, those dollar treasury yields moving higher are challenging for equities, not just from a valuations perspective, but also from a real economic activity perspective. Market rates moving higher, no one pays the Fed funds rate. Everyone pays some version of the market rate. Yeah. And so that can be challenging to economic activity over time. And I think that's why we've seen some of the indigestion over the past few days that we've seen.
Avery, it's been fascinating because even on the up days of the last 2 weeks, it hasn't been one of these buy everything type of days. On down days, it's a little more mixed. There's rotation going on here, and the market is trying to separate out groups that are more or less advantaged in the current moment. Where does that bring you as somebody who tries to play both sides?
Yes, I think it's a very dynamic time because, I mean, as Lauren was saying, from an interest rate perspective, if rates don't go down meaningfully, you have a lot of cyclical stocks that are very expensive that have been pricing in meaningful rate cuts over the next year. Yet you also have other cyclical stocks that are still quite cheap, trading like there might be a recession. And so I think as the data comes in on those less expensive stocks, that if the economic backdrop remains benign to potentially a bit positive, there's a lot of opportunity for upside. And yet, if you continue to see rates stay higher, I think it could be very challenging for certain areas, specifically within housing and certain industrials that are pricing in a real resurgence of demand next year.
What do you think accounts for that distinction between, okay, some cyclicals the market loves and is willing to pay up for, and some have been left behind?
Yes, I think those that are considered to have strong industry structures, the market just automatically projects any positivity onto. So, for example, people think there's a structural deficit in housing, but actually affordability is what drives housing, right? We would all love to live in a larger home in the best neighborhood with the biggest yard.
Yeah, we don't need more at these prices.
We need it more. So I think that there's room, but because of this structural argument about housing's gotten a bid. You have areas in industrials and in transportation where there's considered to be strong industry structure that have gotten a bid. But if that doesn't come to fruition, it's going to be tougher. And then you have other areas like airlines, which are considered to be one of the worst industries ever, right?
Sure.
But we've had a really structural shift in the airline industry that could be very favorable playing out. And so those valuations are still very low.